Johnson & Johnson continues to plummet down over 7% over the last 12 months, but we do notice it is now towards its 52-week low with a double buy rating, Wall Street and Seeking Alpha, with a yield which is higher than its historical average of 3.37%. So is this Dividend King one that is significantly undervalued we need to consider for our portfolio? We're going to take an in-depth look in today's episode. We're also going to touch upon their dividend safety, which is very strong. We'll take a look at some underlying metrics like their free cash flow, their debt levels. And in today's episode, we're also going to see not just how well they've performed against the industry as a whole, but whether or not there is any point in investing in this company as opposed to the S&P 500, looking at its performance. We'll touch upon insider buying, insider selling, as well as what the institutions have been doing in the more recent quarters. And we also just want to update you on a latest acquisition that they have just done over the last few weeks. And also something that we like to consider, whether or not there are other companies in this industry that may be a better option for future growth. And as always, we're going to do an in-depth look at their top line revenue, bottom line net income, as well as looking at how this company's balance sheet is, total cash versus total debt. Not forgetting this one historically has had one of the best balance sheets globally as well. Now, one of the main important parts of analysis is looking at the valuation model if we're happy with this company to add to our portfolio. So we will do a look at the intrinsic value, get to our acceptable buy price considering our investor margin of safety, as well as looking at Wall Street to see what they're forecasting for this price of JNJ over the next 12 months. So the first thing that we do want to do is just reflect on the price movement of JNJ over the last 12 months. Well, down 7%. If you've been a long-term shareholder, you would be up around 43%. Just bear in mind, if you are reinvesting those dividends, it would be slightly higher. As we mentioned already, right there towards its 52-week low. And when we look at the forward P, just under 14, that is very low if you compare it to the S&P 500 trading around 22. We'll also look at how that compares to other in the industry, a more accurate reflection of the forward PE. So in terms of the numbers, very quickly then, we just want to show that on a top line basis, what we typically look for, 3 to 7% growth year on year. What we know, 74.3 billion in December 2014, 85.2 billion in their latest annual report. So it has grown, although when we do take a look at it graphically, we do note a lot of inconsistency, and it isn't direct growth year on year. So some years, in fact, we do see a drop of revenue, for example, 2021 to 2022, and we'll surely look at the percentage increase as well, as that is very important to understand if at a minimum they are keeping up in line with inflation. Bottom line net income, slightly different story. In fact, from 2014, 16.3 billion, December 2023, they've effectively more than doubled that to 35 billion, but we do also note that the majority of that does come from this earning of their discontinued operations. So when you do strip that out, it is pretty much consistent with the prior year. So overall, whilst we do see an increase due to this essential one-off in 2023, it has pretty much been consistent year on year. So just understand this isn't a company like a tech where you are seeing growth on both top line as well as bottom line at a very strong rate. But as we are about to find out, a lot of consistency with Johnson & Johnson. In terms of their total cash versus total debt, well, this is a quick health check. 33 billion in 2014, 26 billion in their latest quarterly report. And over the longer term, their cash position, again, very inconsistent, although we do note still a very healthy amount at around 26 billion in 2024. However, having said that, do bear in mind that these numbers on their own don't really mean anything in isolation. We do compare it to their total debt numerically and directionally. And interestingly, whilst their cash has reduced, total debt, 18.8 billion, has increased in the more recent quarter to 33.6 billion. And again, graphically, we can see over the longer term, their debt has been increasing, but we do see a massive drop from January 23 to December 2023. So lots to consider here. These will all play a part in the analysis, especially the dividend safety. Now what we want to talk about is the earnings quarter on quarter, how they've performed, and their track record, in all honesty, is very strong. The last 4 quarters, although you could argue this is a massive population, they do have a 100% track record of beating what the analysts are targeting. Moving forward into the next 2 quarters, we do note low single-digit decreases to that earnings per share year on year as well. Quarter 4, they are expecting 10% increase. Quarter 1, 2025, a decrease. So again, not a lot of growth, something to factor in, and we can in fact see December 2025, the full year, the anticipation of that EPS is expecting a forward P of 13.46, which although you could argue is lower than the S&P 500 in terms of growth, it is maybe understandable why they do trade at this forward P for now. The next thing we want to draw your attention to are some gradings. First one, valuation grade. They do get a D-. Now let's just take a quick look at why that is. Firstly, one of the things we point out, the P on a non-GAAP basis, 13.93 as we established at the beginning of the episode, 19.52 in terms of the sector median. So the sector as a whole does trade much higher, but we might find out in fact it is warranted if they do have better growth rates, better profitability. Again, you can see different methods of valuing companies depending on what you like to look at. For example, on a price to cash flow, 15.26, lower than the sector at 18.56. Although if you're someone who looks to look at a price to book, 5, with others at 2.48. Again, really depends on what valuation method you use. As an average, though, they have scored a D-. We then draw your attention to the growth grade. Now, they get a D on the growth rate again, so another very poor mark. In terms of year-on-year growth, well, 10.6%, that is nice, especially not just the fact it's double digit, but the sector as a whole coming in at 7%, so it is better. When we look at it on a forward basis, though, negative 1%, as we can see, the sector as a whole, 9%. So forward looking, not great growth, in fact, negative growth, do bear that in mind. And the other thing that I would say is quite disappointing with Johnson & Johnson is the earnings per share growth rate moving forwards over the next 3 to 5 years, 4% on average year on year, whereas when we look at others, double digit 11.10%. And again, you can see other metrics here depending on which ones you really want to include in your own investment thesis, but overall they do get that D grade. So 2 poor grades, valuation and growth. Now we take a look at their profitability, the best rating we have seen so far, and that is an A+. Gross profit margin, well, 69.34%, better than the sector median at 57%. And when we look at the bottom line net income margin, nice to note, in fact, not only 45%, but the majority in the sector, negative 4.5%. So they are loss making, even if they do have a lot better ratings like on the growth and the valuation. And we can see Johnson & Johnson, massive cash from operations, 23.2 billion, sector median, negative 16 million. So again, you can draw your own conclusions. This is just the first part of our analysis, but as an overall conclusion to this element, a double buy rating seeking alpha in Wall Street, a hold from quant, D- on valuation, a D on the growth, and an A+ on profitability. We then move on to looking at how they've performed against others in the sector. Now, this is the pharmaceuticals. We have Merck & Co., AstraZeneca, Roche Holding, Pfizer, GSK, lots of big names that we have looked on this channel over the last 12 months. Now, bear in mind, this includes reinvesting those dividends, negative 4%, and in fact, they aren't even the worst performing. As we see, half of these that we have selected today are in fact negative performing over the last year. We then expand this over the last 5 years, and what we note, again, they are in the middle performing. They're up 21.81%, but over a 5-year performance, that is very poor. Just something to bear in mind though, and over the last 10 years, we note they are again in the middle. So typically over the last 10 years and over the last 5 and 1 year, they are sort of in the middle of those competitors. 89%, not the greatest return over a 10-year period, but remember, always key to understand that past performance is never an indicator of future performance. Now, another thing that I do want to talk about, something that maybe we can incorporate moving forwards, is the performance of individual companies against the S&P 500. At the end of the day, you may look at these companies and think if they don't outperform the S&P historically, then are there any point in investing in them as opposed to just looking at an ETF like the S&P 500, like VO, like SPY, depending on your preferences. So year to date, the S&P 500 up 12%, Johnson & Johnson down around 5%. When we expand that to over the last year, again, S&P has really outperformed Johnson & Johnson. Over the last 5 years, again, we see the same 86% versus 22. And when we look at it over the last 10 years, 176 versus 89. You could argue the S&P 500 has a lower yield, and maybe this is more for those who want consistency in their portfolio with minimal drawdowns during tougher periods like the recession. But again, as you can see, over the longer period, S&P 500 in terms of total return, so that means including including dividends reinvested, has performed a lot better. But the same thing we just mentioned does apply. Past performance, again, is not an indicative of future performance. Now, before we look at the underlying metrics like the dividend safety, the free cash flows, a few things that we do want to draw your attention to. Now, insider buying, insider selling, insider ownership as a whole, 0.16%, 17.31 million worth of sales by insiders. In fact, numbers of insider sellings has been 5 with 0 insiders buying. Quarter 2, however, the more recent quarter, no movement. Quarter 1, we do see 9.38 million worth of sales. And if we look at who those insiders were, in fact, it was just the EVP on the 9th of February. They sold just under 60,000 shares for around $9.3 million. Again, the price of 156, that is higher than what it's currently trading at. But again, up to you if you do see this as a bearish signal. In terms of looking at institutional ownership, well, fairly high, just under 70%. We do in fact see 19.9 billion worth of buys with 29.52 billion worth of sales. Interestingly, one of the first that we have reviewed where we see more selling by the institutions than buying. And on top of that, for another blow, we do note in quarter 1, the latest quarter, a lot more selling by institutions than buying. So overall for Johnson & Johnson, for this part of the analysis, insiders have been selling, although it was just the EVP, so one insider with a large sale. But the institutions not only selling more over the last 12 months, but also in the latest quarter of Q1. Now moving on to some news, or more recent news. In fact, we do note that Johnson & Johnson did complete their acquisition here of Shockwave Medical, and they do help when looking at the segmental analysis of their revenue, that it will really help drive cardiovascular technology in the industry. As we can see here, through the innovative medicine and medtech, Johnson & Johnson is transforming the trajectory of cardiovascular disease, which they do state is one of the leading causes of deaths globally. So hopefully this will help not just their top line in the income statement, but also in terms of the deaths globally, reducing that number. But again, we will need to wait and see how long that will take for to really impact their top line. As we saw earlier, their top line increases over the longer term has not been anything great. Now, before we do take a look, I just want to point out that there is an article that was released around 3 to 4 weeks ago, and they do talk about ignoring Johnson & Johnson and focusing on another healthcare stock instead, and this is AstraZeneca. Some of the reasons that they do talk about Johnson & Johnson not being what it used to be, as we can see, it isn't the ultra-safe stock that it used to be. They talk about it being full of uncertainty and risk that we can capture very shortly, and they talk about the legal problems could essentially cause this to be 3M Part 2, where essentially, as we saw, they had a lot of legal problems, which we have discussed not too long ago, and they effectively had to reset their dividend payout, removing them of that dividend king status. Now, when we just take a look at a few points, as we mentioned, AstraZeneca, they do like this. They talk about their growth being a lot better. With Johnson & Johnson, we do see single-digit growth, whereas when we do look at AstraZeneca, they do see this as a lot better. In fact, they talk about their revenue just up 19% year on year in the latest quarter, with their oncology up around 26%, whereas Johnson & Johnson 5 to 7% to the end of the decade. What we saw was for the next 3 to 5 years around that 4 to 5% level. They also talk about Johnson & Johnson should be trading at more of a discount and not what it is currently, and there are lots of things that you also need to take into consideration, whether or not you want to invest in a single stock, or in fact if you think the S&P 500 is a safer bet. So lots of different things to consider. We just wanted to highlight that. As we said earlier, there are some legal issues with Johnson & Johnson. Nothing has been sorted yet. And then whilst they have tried to sort this out, as we can in fact see, they still have that cloud of their unresolved talc lawsuits hanging over them. And one of the reasons why they do think that this trade should be at a much, much larger discount. And as we saw from earlier episodes, their bankruptcy filing for their subsidiary, nothing has gone through yet. So they are waiting for this to take place in court. It is, in fact, their third attempt at doing this, and there is no guarantee. So this is something we will cover when we do look at that margin of safety to understand whether or not there is sufficient amount for us to execute on this company. Now, we also just want to point out that we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on that pinned comment below. For example, if you want to see what websites and resources we use, you can click on this article, and our latest one does run through 12 high-quality undervalued dividend stock. Now, let's jump into the dividend safety. Score of 99, very safe, in fact, the highest score obtainable. market cap 354 billion, a mega cap company, and it was just reaffirmed a few months ago that their dividend is very safe, so a dividend cut does look to be highly unlikely. Now, for those that like to look at comparative data, well, in the last recession, they did in fact increase the dividend during the 07-09 Great Recession. They had negative 6% sales. Remember, that is above the average of the S&P during that time, negative 12, and they also outperformed the S&P, negative 27%, with the S&P negative 55 during the period. Now, with this company, don't expect a great dividend growth, double-digit year-on-year. In fact, the latest increase in April this year was 4.2%, in line with the 4% we advocate on this channel at a minimum, just to keep up in line with inflation. And when we take a look at it over the last 6 years, or in fact 5 years at 6%, 20 years at 8%, we can in fact see that this is a company that at a minimum is increasing it in line with inflation. As we said, they are also a dividend king. They have increased those dividends for the last 50 years or more, with paying a dividend for the last 108 without a reduction. Now, in terms of dividend yield theory, for those that are new to the channel, it does say the company is undervalued when the current yield sits above the 5-year average. So we do have our first sign of undervaluation. Bear in mind, we're not looking at any of these models in isolation, and the forward P 13.9 is below that 5-year rolling of 16.4, as well as below the healthcare 16.8. Then when we move on to look at some of these metrics, the first one, the free cash flow payout. Remember, always free cash flow over the earnings, which is susceptible to manipulation by management through accounting, and below 60% is the target. Pretty much below that every single year, bar the last 2 years. Nice to note, 2024 anticipated to come down to around 55%, so we can see why that dividend does look to be safe. The next thing to note is free cash flow per share. We want increasing free cash flows year on year with consistency, and what we do know over the longer term, you get the consistency, but you don't get a lot of the growth. 702 in 2023, 908 expected next year, so that is some nice growth. But again, just bear in mind with this company, the growth is a lot slower than maybe you would expect from other companies in a similar industry, like we saw AstraZeneca, double digits expected just on the revenue alone. Sales growth, and as we can see, 3 to 7% was what we warranted for a steady, moderate company. And what we note here, very inconsistent, but over the longer term, you do expect that 3 to 7% to be hit. 6% in 2023, 11% on a trailing 12-month basis. Hopefully, we get a very solid 2024 for Johnson & Johnson. We see their total sales, another format to what we initially looked at. And in terms of returning excess cash through those share buybacks, something that they do incorporate over the longer term, but bear in mind, not a lot of consistency. In fact, from 2019 to around 2022, there was very minimal movement. That is something that we have seen over the longer period. In terms of ROIC, return on invested capital, as always, 10% or more to give us faith management are able to effectively allocate their capital. Very consistently, pretty much around the high teens, the low 20s year on year, makes it very attractive for investors to consider this within their portfolio. And when we look at the margins operating above 12%, very positive, very consistent, and the same to be said for the free cash flow. So margins, something that we see is very good for this company, as we saw that valuation grade for profitability for JNJ earlier was sitting around the A mark. Now, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, below 3 is our target. Remember, these are the number of years it would take the company to pay off their debt net of cash on hand. And we can see 0.25 in 2023, 0.23 in 2024, very low, very positive. Balance sheet looks good. Remember, this does correlate to both dividend safety and balance sheet, so no worries whatsoever with this balance sheet company. Very high grade, as we mentioned earlier on. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model we're looking at is the multiples valuation model. Companies in a similar sector and size. We have their P multiples, the average P multiplied by the EPS of J&J. To get our intrinsic value here, 160 essentially with a market value of 146. We have our first undervaluation signal. Just bear in mind, we don't look at any of these models in isolation. We then have the DDM model, the yearly dividends. As we can see, average growth rate 5.5%. Forward looking, we have gone lower than the average, slightly higher than the more recent increase. We do think this is fairly fair at 5%, and this gives an intrinsic value showing undervaluation 17360 versus the 146. We then move on to the DCF model, free cash flow year on year. Average growth rate looking flat. Forward looking, we've gone for 6%. Again, we do see it more on the conservative side. With the discount rate at 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by shares outstanding, and as we can see, a nice undervaluation signal. So the intrinsic value today's episode, the average of these three, as we can see, it is arriving at $172. And as always, you can click on the pinned comment below to grab a copy of this model, get to the intrinsic value and acceptable buy price of companies in your own portfolio, as well as those on your watch list. Margin of safety, then, as always, we start off with 10%. Remember, we only execute if it meets the three criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy up to 155, then we keep going till it's near the current trading price. And in fact, in today's episode, this is one that we do see at a 15% MOS level. Again, depending on the investor, what they believe, the investment thesis, the talc lawsuits with their recent acquisitions, how they believe the future of this company will be. It has underperformed the S&P over the last 10 years and pretty much over the last 1, 3, 5 as well. Now, when we take a look at Wall Street and their expectations over the next 12 months, they do see around 20% upside, $175 forecast, which isn't too far off our intrinsic value. Now, in terms of my thoughts, this is one I do hold in the portfolio, and it is one that I would look to add for stability, but it isn't one that I would be looking at around a margin of safety of 15%. Currently, at this rate, I would look towards the S&P, which does have a much better outperformance. But again, if you can get Johnson & Johnson at a larger MOS, this could be one to add for long-term value, as well as just the consistency in the portfolio. So this is something that maybe at a 20% MOS level at 138 or at 25 at 130, something to consider. But right now, at a 15% margin of safety, for me, this is one that maybe it could be a hold. But as always, let me know your thoughts in the comments below. Is this one you're looking to buy? Maybe one you're looking to hold, or in fact, maybe looking to sell to put your money elsewhere. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are notified of when these videos drop. And as always, we'll see you all on the next one.